Hi, this is Martin Andelman from Mandelman Matters, and I'm sending you this video, well, for a couple of reasons. One is that with COVID being what it still is, it's unlikely I'm going to bump into you anywhere else, so I thought I better send you something that you could watch. And the other is because I wanted to talk to you for a minute about long-term care. Now, I know you're a financial advisor. You know that long-term care is an important thing. It's something that protects people's assets later in life in the event that they need, assisted living or nursing home care. But you also know that a big percentage of people chose not to buy it. And you know how that happens, right? People look at it in their 50s and they go, well, it's a good idea, but I've got a lot of other things to pay for. And so they skip it, or they say, I'll look at it later. And oftentimes by the time they get into their mid 60s or early 70s, it's just become prohibitively expensive. And so they end up with a strategy that sort of goes like this: I hope I don't need it. Well, hope's not a great strategy, and we know that people are vulnerable to these kind of expenses later in life. So I have an answer for you that you probably haven't thought of before or even heard of before, and it falls under the banner of the HECM, H-E-C-M. That's the home equity conversion mortgage I've sent you some other videos about. It's the government's reverse mortgage program, and I know you're probably thinking, well, that's for people who are having financial difficulties. But it's not true. The HECM program can be used for all sorts of different things, and one of them is to protect people from the costs of long-term care. Here's how it works. It's called the HECM Line of Credit, and it's similar to a home equity line of credit, a HELOC that you're very familiar with, I'm sure. The difference is that the HECM Line of Credit is better in just about every way. For one thing, it can never be canceled. So unlike a HELOC where the bank can cancel it unilaterally at any time, the HECM line of credit is guaranteed for life. It never goes away. And it goes up every year by whatever the interest rate is plus half a point. So let's say the interest rate's 3.5%, plus half a point is 4%. So your HECM line of credit goes up every year by that 4%, whatever the interest rate is plus half a point. So let's say that you opened a HECM line of credit and you were 65 years old and you opened the line of credit for $200,000 and then you didn't use it because you didn't need it. So you just let it sit there and grow every year. It increases every year, guaranteed. So the first year it's $200,000 and the next year it goes up by 4%. So it goes up to $208,000. And then the year after that, it goes up 4% and goes up 4% every year. It compounds. So by the time, if you opened that when you were 65, by the time you hit 85, that line of credit would be about $800,000. That's $800,000 that would be available to you tax-free to use for absolutely any purpose. You wouldn't have to qualify like as you do with long-term care based on the ADLs and the activities of daily living. You wouldn't have any of that. You could use the money however you wanted to. The other thing is, with a HECM line of credit, you never have to make a payment. Never. You can simply let that balance sit there. It'll accrue the interest, but you never have to make a payment. Nothing else will allow that. So that means that when you turned 85 years old, assuming you did this when you were 65, you'd turn 85 and you'd have $800,000 in a tax-free bucket of money that you could use for any purpose. Now, with a HECM, you still need to make your property tax payments and you still need to pay your insurance and regular maintenance, but you never need to make a payment on the money that you take out of a HECM. Now, there's other things that you should know. And what I'm hoping you'll do after watching the video is click the link below, send me an email, I'll get in touch, and hopefully we can set up a Zoom meeting since we can't meet in person at the moment, and I can answer more of your questions and show you more of the details. It's important. Your clients do need an answer for long-term care, and if they're in their 60s or 70s, that answer may have passed them by. It might be too expensive now to buy long-term care insurance, or maybe their health won't allow for it. The HECM line of credit, none of those things are a concern. You don't need to qualify based on your health. It's not an insurance product. It's much easier to get than other types of mortgages. It's not a credit-driven product. And you can just let it sit there and grow every year. And of course, if you never need it, well, then you never borrow it and you don't have to pay it back. So it's really a non-issue. Listen, this is an important thing that not a lot of people are looking at and not a lot of people understand. So click the button, send me an email, and we'll do a 20-minute Zoom call. I'll answer all your questions, and I'll show you the different ways that your clients can use the HECM line of credit to protect their assets as they get older and may need long-term care. All right? Thanks for listening. I'll be back with another message next week. Until then, click the link below. Let's meet on Zoom.